Yeah, demand for credit is strong. The economic conditions are buoyant. We really sort of started to see that in our own funds in terms of the companies that we provide financing to really turn very early on in 2020. So we obviously had a fairly substantial market dislocation through sort of March, April and May of last year. But then what we saw was the companies that we were financing, their confidence in terms of their future performance was quite strong. And so really from, toward the back end of, the lockdown in Victoria, we really did start to see confidence building. And across the companies that we lend to, we actually saw them, outperforming, what were pretty strong stretch budgets. So the demand for credit is strong. Interest rates are low, and so we're seeing a lot of activity. The two real drivers for us in terms of demand for credit really come from two sources. One is commercial real estate related activity. There's a big consumer of capital for us. The other area of demand for credit really comes from acquisition financing. So we support and provide financing to a range of private equity firms that are active. And so if you see company acquisitions and those private equity firms, selling their existing portfolio companies, a lot of that creates opportunity for us in terms of opportunities to lend to those companies. Yeah, it's interesting. I think a lot of investors have been looking for alternatives. They've sort of experienced a situation where they've been subjected to sort of quite substantial bouts of volatility in public markets. Particularly in that market dislocation period in early 2020. And I guess what investors have really been looking for is ways in which they can reduce that market volatility. And then how do they get an acceptable return? And I think one of the things that was obvious in 2020 was the volatility, not only in terms of the market pricing, but also, particularly if you're an investor that's invested in equities to receive an income, the cuts to dividends were quite tough as well. And so I think a lot of investors have sort of looked at their portfolios and said, I've got a lot of equity exposure. How can I best diversify my exposures or my assets? We present an attractive alternative for investors where they're looking for more stable capital in terms of lower risk of volatility, but also where we present an opportunity to receive a regular income. And so the income that we pay across our funds is distributed to investors on a monthly basis. So that's been attractive. We've seen a lot of interest from institutional investors. We have a number of large insurance groups, for instance, that have invested in our funds, superannuation funds. We're even seeing a lot of demand growing from a range of offshore investors looking to access our funds. I think one of the things that's been interesting is whilst public markets have been quite volatile, what you've seen in our asset class is more stability of capital, really due to the protections that are afforded to an investor in debt. So as a lender, what I want to do is ensure that I've got appropriate terms and conditions and controls imposed on the borrower to ensure that our investors' capital is not at risk of loss. So equity will wear the volatility. Equity should be the asset class investors are investing in for growth. You invest in the debt part of the capital structure to receive a return and ensure you've got the benefit of the protections associated with the security that you take over the company, the covenants, the controls. They're designed to be mitigants to risk of loss. And so a lot of investors are saying, okay, that's an attractive asset class for us. If you can get a reasonable return and you've got lower levels of volatility of your capital, then you can see it becomes an attractive alternative, particularly when interest rates and other alternatives are not delivering the income that investors demand. Look, I think at the end of it, interest rates are low. We've had material cuts. There's concerns building in the market around future rises to inflation. And so I guess you don't want to be in an investment product or a debt product where you've got exposure to fixed rates. And so obviously if you're involved in an asset class like ours, if interest rates were to rise, inflation was to rise, then the total return that you as an investor will receive will increase as the base rates flow through in terms of higher total returns to an investor. So what I think are the important characteristics of investing in debt. I think short-dated exposures in floating rate instruments are particularly attractive. Short dated because it reduces your risk around credit risk. It reduces the market volatility and market risk that you take. Plus it also gives you, as a lender, a more frequent opportunity to generate fees from refinancing events. So they're the sorts of things that we try to deliver for our investors.